Good morning. Good morning, Akhil.
Good morning, sir.
So, I'm troubling you in the weekends because next week I will be traveling. Can we start, Harika?
Yes, sir.
What's time there in India?
7:12, sir.
7:12. Okay, fine.
Yes.
So let me share the screen. So yesterday we have tried to understand some of the terminology of this futures and forward market. Okay. So all of you should be comfortable with this terminology and any questions or clarifications from what we have studied yesterday or day before? Like you should be comfortable with this, underlying what is underlying instrument, what is underlying price, contract size or lot size, contract cycle, expiry day, tick size, what type of settlement we have, daily settlement, mark to market settlement, and final settlement. So you should understand that there are basically two prices. Okay, so let me take the board. Are you able to see this screen, whiteboard?
Yes, sir.
So now you see here. We have a spot price and a futures price. All of you are clear in this? There is one market or segment, cash market or spot market. Another is futures market. Akhil?
Clear, sir. Clear.
Understood.
Understood.
Very good. So there will be some difference between spot price and futures price, is it not? Say spot price for no TCS is something like no 650, and futures price will be some 660. There will be some difference, no? Because we are not paying the full amount. We are not paying the settlement is not immediate T+1 settlement. It can be taken taken into the future for 1 month, 2 months, 3 months. There will be some difference. Okay, we'll take it from there. Whatever no, whatever slides are showing here. So the same the type of no jargon we are using, or no terminology we are using in the derivatives market. The difference between the spot price and futures price is called basis. This is what the terminology. Futures price minus spot price is called the basis. So now suppose in TCS case, what is the amount of difference between futures minus spot?
10, sir.
10, yeah, 10 rupees. So this 10 rupees is called the basis, the difference between futures and spot. So this is also called no, your cost of carry. That is carrying the position. Because you are not settling right away, you are able to take this position into 1 month, 2 months, 3 months, or so that is how the amount. This is called cost of carry. When futures price is greater than spot price, we call it as positive. When futures price is less than spot price, it is called negative. So this is how cost of carry works. Cost of carry means that is how much is the difference between futures price and spot price. Or that is also called basis. Now, yesterday also we discussed about this margin account and initial margin. Now, who will decide this margin? Yesterday also we discussed no, that in futures, there is something called margin. You need not pay whole amount. Suppose, for example, 10%. You are buying for 1 lakh rupees. So how much you will pay? You will pay only 10,000 rupees. So this is called your initial margin. Okay. Then if you are making profits, you will get credited into your account. If you are making losses, your account will get debit. Okay. This is what we call daily settlement or mark to market settlement. That means daily your position is seen, assessed for whether you are having profits or losses, and these things they will be, if you are making profits, you will be credited. If you are making losses, you will be debited. Okay. So there is also some concept called open interest and volumes in futures market. Now all of you carefully see this table. Are you able to see the table, Akhil?
Yes, sir.
Now you carefully see here, because sometimes it is also confusing to me also. So don't worry, because we have to, this is a technical topic. It's not like your HR or marketing where you can easily see the examples. Here you have to imagine the market and you have to see the NSE, how trading goes on. It is a technical subject, but unless you know something technical or something, then only it will have value. If you see, you can't say that I don't want to stress myself in learning. You should learn the advanced topics. Then only some value addition is there. So there is something called open interest and trading volume in futures market. Suppose you see here, you go to NSE India. If you see the futures market, all of you should regularly see this NSE website, take the data, understand the data. Okay. See here, what contract I am seeing, what instrument I am seeing, TCS futures. Are you able to see this line? What I am highlighting?
Yes, sir.
So this is a TCS stock futures. Various data is given: expiry date, open, high, low, close, previous close, change, last change, percentage change. Volume is giving. Volume is how much, how many contracts he is saying?
7,938.
8, very good. 7,938 contracts are traded. That is called volume. Now there is something, again he is saying open interest. Open interest, how much he is saying?
$74,602.
Yes, 74,602. So why the difference between open interest and volume? Now let us come to our explanation in the table. Now volume means, so you carefully understand this futures market, it has an expiry. So today, suppose all contracts will become zero on 29th June, on the last day of that contract. So when we say that a contract is opened, when there is a buyer and seller, we say that there is a contract has opened. Okay, so you carefully understand this. Open interest means how many contracts are open on that day, because some person will be buying, some person will be selling, some person will be squaring off in that, and new positions will be open, new people will come into the market. So like that, there will be continuous trading. On 29th June, it will become zero because everything expires. But in between, there are a lot of people will be trading. So how many open contracts are there? How many people are that is interested in that contract? TCS 29 June futures, how many people are interested? That is called open interest. On a particular day, how many people are trading? How many contracts are trading? That is called volume on that day. Now let us see carefully. So the contract starts on March 1st, suppose. There is one person, A, he sells 50 contracts. That is what we call short. Because A is selling, somebody should be buying, then only that we say that there is a trade. A is selling 50, B is buying 50. Now, what is the trading volume for that day?
50.
50. You are clear? Yeah. Now,
Yes,
how many contracts are open in that June contract? Because this is the initial day, first day. So what is open interest?
50, sir.
50. Very good. Now next day, you come to next day, March 2nd, another person comes. Another person, C, he buys 100 contracts, D sells 100 contracts. So unless there is one buy and one sell, then we say that there is a trade. If one person is long, another person must be short. Isn't it? For one position, one contract, there will be one buyer and one seller, one long and one short. Then we say that it is a trade. Now, in March 2nd, what is the trading volume for the day?
100.
100. Very good. Now, how much open interest will become? How many people are interested? That is, what is the total open contracts?
150, sir.
150 because 50 is on the first day, 100 on the second day.
Yes, sir.
Now you come to the March 3rd. March 3rd, what happens is A closes is a short position by buying back 50 contracts. And E sells 50 contracts. You carefully understand. So now A is buying 50, E is selling 50. Now what is the trading volume for the day? Harika?
50, sir.
50. Trading volume. Now come to the open interest. In this open interest, A is already having 50 contracts. That 50 contracts is closed. From E. So there is no effect on the open interest. That 50 is squared off. So how much open interest?
150, sir.
150. Because same, it remains same.
Okay, sir.
Next March 4th, C closes 100 contracts. And D closes short position by buying back 100 contracts. So what will be the trading volume? Hundred contracts are traded between C and D. What is the trading volume?
100, sir.
100. Now the C and D are already in the market earlier in March 1, 2, and 3. Now 100 contracts are closed in the existing the open contracts. 100 contracts are closed. So earlier we are having open interest 150. Now 100 it is down because C is out of the market, D is out of the market. They are no longer interested in that contract. They have closed their position, they have squared off their positions. Now what will be the open interest?
50, sir.
50. Excellent. So this is very no, somewhat you have to think over and deliberate, because there is a lot of people get confused between open interest and volume.
Sir, then March 4th, 50 contracts are ease contracts, no, sir?
Yeah, 50 contracts are outstanding. 50 contracts are open interest.
Okay, sir.
In that 29th June contract of TCS, only 50 contracts are in the open interest. That means the people are not interested in that contract. It is going down. Open interest is going down. Open interest tells me how much interest is there in that instrument. Whether it is no, this open interest increasing or decreasing is itself is an indicator of how many people are interested to have positions in that. So depending upon volume and open interest, the market players will try to gauge the sentiment of the market.
Yes, sir.
Okay. You should carefully follow and analyze this. So, any other observations, Akhil?
No, sir. Right now, no, sir.
Okay, you just no. After going home, also I will share the slides. You again go through this.
Okay, sir.
Now, there is something called price band. The price band means, see, if you see the NSC site, because these are all practical things. Always you should learn practically. Go and see in the NSC website, and see here open interest, change in open interest, percentage change in open interest. All these things are there. So price band means it can't fluctuate. Say more than 10%, 20% like that. See here. How much on the day it can go? Upper TCS can go up to 3,000.
560, sir.
560. Lower
2912, sir.
2912. So presently it is something 3,200. So something like 300 rupees he has given. It can go up or it can go down. It is some sort of precaution.
Upper circuit.
Upper circuit, lower
Cannot
circuit.
go beyond that, sir.
Yes, very good. That means it can fluctuate in that band, so that there is no extraordinary fluctuations. So you know about long position, short position. Long position means when I'm having a positive view, I am expecting the price to go up, I will purchase. So that is, then I say that I am long on the market. Short position means when I am having a negative view, when I am thinking that the asset will go down, I will create a short position. That means I will sell that asset and I will look forward to buy back again. So for long position, I can square off. Short position, I can square off. Square off means opposite of that. If I am long, I will sell that position to square off. If I am short, I will buy that position to square off, so that my net position becomes zero. Open position. So suppose if you see here, open means it can be long or short. It can be long or short, isn't it? So square off means when I do the opposite position, that means square off means I don't have any position, zero. Now suppose for example, I have purchased one lot of TCS. Then what I am called? I am called long TCS or short TCS?
Long, sir.
Long. Okay. Now I want to square off this long TCS position. What I have to do?
Short, sir.
Short. Okay.
Sell.
Sell this position. Suppose if I am selling one lot of Reliance, then what type of position I am having?
Short, sir.
Short. Very good. I am short Reliance futures one contract. Now I want to square off. What I have to do?
Buy, sir.
Buy. I have to buy this. Okay. Then I say that it is my position is squared off. If I have an open position and I keep quiet, I can do anything in the meanwhile. If I keep quiet till expiry day. Expiry day is when expiry date is that is 29th June. What happens on that day? It will be automatically squared off and the exchange will give you the difference. That's what we call expiry. If you keep quiet, if you don't do anything, automatically your position will be squared off. And it will be made zero at the final settlement price. The final settlement price will depend upon the final trading day, and they will arrive at the final settlement price at the exchange. In the meanwhile, you can square off yourself. If you don't square off yourself, the exchange will square off. Because the contract is no longer valid after 29th June 3:30. Are you clear?
Yes, sir.
Yes, sir.
So there is another term which is called naked position and calendar spread position. Okay. So naked position means you purchase or sell one contract. That is, there is no other position except your long or short position. So small modification is there. That is, suppose I can do like this also. I am long one lot of TCS June futures. Okay. And then immediately I sell. Immediately means suppose next I sell one lot of TCS June futures. Then what happens to my position? Is it open or squared off?
Squared off, sir.
Squared off. Okay. So instead of this, I sell one lot of TCS July futures. Now what happens to my position?
Open, yes, sir.
Open. What is that? Is I have two positions open, two naked positions. One is long, one is short, but in different calendar months. Suppose this is 500 rupees. This is 510 rupees. This is what you call calendar spread position. How much spread is there now between TCS June futures and TCS July futures? How much
10,
amount
sir.
difference? 10 rupees, isn't it?
Yes, sir.
So this is also possible in your futures market. That means you buy 1 month contract, sell another month contract, so that you have some spread. Your expectation, I don't know what you are thinking. You may think that both will come to some 500 rupees and you can pocket that 10 rupees. You have different strategies. If I think that at the the spread will come narrow down. Now calendar spread now is how much? 10 rupees. After 10 days, suppose after some time, ECS June ECS June becomes 502. ECS July becomes 504. Suppose TCS June futures. Because they will be fluctuating. Now suppose I want to close my position and see what happens. Now if I want to close my both the positions, what I have to do in the first instance? For my long position, what I have to do?
Short.
Ah,
They have to sell,
yes,
sir.
yeah. For the purpose of understanding, let me modify these rates. Assume that this will become 498 instead of 502. I may have to take the eraser. So instead of 502, you take this as 498. Oh, this, so TCS June 498. So if I sell TCS June, how much loss I will be getting? I purchased at 500. You forget about this. This I am trying to erase. Instead of 502, you take 498. Okay.
Okay, sir.
Now I sell at 498. What happens to my how much loss I will be getting in TCS June futures?
2 rupees.
2 rupees. So I am getting -2. -2 in my long position. Now in July futures, if I want to square up, what I have to do?
Buy, sir.
Buy. Buy at what rate?
504.
504. So how much profit I am getting? I am buying at 504. I have sold at 510.
6 rupees, sir.
6 rupees. Very good. So how much profit I am getting?
4 rupees profit.
4 rupees. This is what we call calendar spread. I am not. If I am having naked position, I will be exposed to more risk. But it is a calendar spread. I am limiting my risk.
Yes, sir.
I will again come to that. For the time being, you just remember this. So all of you know this, but I will try to. Priyanka, are you there?
Yes, sir.
Yeah, okay. What you just note down all the students who are attending this Zoom session.
Yes, sir. I noted, sir.
Okay, okay. So there is something called payoff charts for the futures contract.
అన్నా ఇంకో చపాతి కూడా అన్నా మొత్తం 3 చపాతి ఒక పరోటా.
So So you see here, futures contract. You see the chart table here. Are you able to see the table and chart?
Yes, sir. We
Yes,
can
sir.
see.
So if you are long a futures contract at 100, if the price at expiry, if it is going down, you will get loss. Suppose if the price at expiry is 70 rupees, how much you will get loss? I'm long futures contract at 100 rupees. This is 100. If the expiry price going down, I'm getting loss. Is it not? If it is 100 rupees, it is 0. If it is 90 minus 10 like this. Are you clear?
Yes, sir.
Akhil?
Yes, sir.
If it goes up, you will get profits. Is it not? If the price goes up, if because you are long at 100 rupees, if price is going up, you will get profits. So this is called a payoff chart. How much profits or losses I will get when the expiry price moves. I am having a long position at 100 rupees. So depending upon the expiry price, it will be, I will be getting loss or profits. Same thing like you are owning an asset. So that is why we say that there is a linear payoff. See, if the price is at 100 rupees, if the price goes down, I get loss. Price goes up, I get profit. This is what you call long futures position. Short futures. Short futures means when you will get profit.
When price is reduced, sir.
Yes, when price is because you are having a negative view, you are having a pessimistic view. So you are short. When your price is going down, you will get profit. When price goes up, you will get loss. Is it not? Are you clear, Akhil? Akhil, are you there?
Yes, sir.
Yeah. So Akhil will sponsor parota for all of us after the class.
Sir, mute lo పెట్టడం మర్చిపోయినా సార్.
Okay, no problem. No, I am just you have to sponsor parota for all your classmates.
ఓకే సార్.
So now this is that's why we are saying that futures is an instrument which moves linearly, like your asset. I will get unlimited profits, unlimited losses as the price moves. Is it clear?
Yes, sir.
So now, what will be the futures price? Say futures price. How much will be the TCS June future price should be? Who will decide that TCS June futures price?
Buyer and seller, sir.
Buyer and seller. Very good. So buyer and seller, depending upon their expectations, they will come to the market with their buying orders, selling orders. and they will try to interact and form an equilibrium price, and they will contribute to the price discovery with their risk amount. They risk their money and try to form a price. That is one part of it. But we should have some theoretical model for that. Like who will decide the share price? Share price is decided by buyers and sellers. But still we have our own valuation methods. Like we have DCF valuation, relative valuation, that is a comparative methods, balance sheet valuation, all these things are there. We have some model, some theoretical model, and actually there is a, that means we decide an intrinsic value by evaluating all these things. And there is a market price. We expect that the market price follows our valuation model. So you should have some estimate, some model. Is it not? So for that, we have what we call cost of carry model to evaluate the futures. We have what we call cost of carry model. In the cost of carry model, what we will decide is what is the fair price of a futures contract. How much a futures contract should be there according to our, that is what they say is that futures price is equal to spot price plus carrying cost. Carrying cost means nothing but our interest charges. Because suppose you say that today 49,000 is the gold rate. Now you go and say that after 2 months, you give me this gold. I will pay at that time. If you want, I will pay some 10% advance. Then the goldsmith will not give you at the same rate. He will add his own interest cost. So he will say, how much I will give you at 50,000 after 2 months. So how he calculates that? It is not some random number. He says he takes into account the interest cost and depending on that spot price. So today is 49,000 plus interest cost. He will calculate what is the rate of interest. That is how he calculates. So the same model we are applying here. So they say that this futures price, let me take the whiteboard. So futures price is what? Spot plus carrying cost. Carrying cost, what do you mean by interest charges and everything? Or in equation terms, what we call is spot price. If there is a, what is my cost of funds? And this should be to the power of, that means we are compounding it. Because there is something called in finance, we take this as a, in financial markets, continuous compounding. Because these prices will be trading continuously. Continuous compounding. Continuous compounding means normally we say that what is quarterly compounding, half yearly compounding. No. yearly compounding like that. But in financial markets, for easier understanding, we say that this is continuously compounding. That means this T that is infinite. So in that time, mathematically, what will happen is this S becomes this 1 plus R to the power of T. When T tends to infinity, at the limit, it becomes, there is some mathematical constant, e power RT. This has to go to the top. You can see in our slide. This T normally we calculate in years. That means if it is for 6 months, then T becomes 6 by 12. That means 0.5. If it is 3 months, we say 3 by 12, it is 1 by 4 or 0.25. Any questions on this? Any clarifications? Akhil? Harika?
No, sir. No, sir.
No, sir.
Now you just look at this question. Forward price or futures price, same model, because forwards and futures are same linear instruments, except what is the major difference between forwards and futures?
Sir, forwards is over the counter
Hmm.
and futures is exchange traded.
Excellent. That is all of you should remember. That is a major. Now, if you have a calculator, you can calculate. Suppose here you see how much you put all these things in your equation. Is it not? So, suppose if you put all these things in your equation, I want to find out this F futures price, how much. But what I am given spot price. What is the spot price is telling? Spot price you just note down that what is spot price in our problem?
$75, sir.
1 minute. 75. I am lost in this. So futures price I have to calculate. Spot price is 75. How many months that is, what is the rate of interest? Do you have it, Priyanka? That,
8%, sir.
Nana?
Sir,
Do you have that problem with you?
1 second, sir.
Jayajan, tell me, what is the rate of interest? How much percentage?
Eight percent.
8%?
Yes, sir.
So 8% means 0.08. How many months? This is what is in your this thing, question bank. Unit 2.
Sir, 6 months.
6%?
6 months, sir.
6 months. So 6 months means how many years?
0.5.
6 by 12, 0.5. Now I have to, and what he is telling? He is telling continuous compounding or simple compounding? Can you read out the total problem?
Yes, sir.
Yeah.
Calculate the forward price
Hmm.
on a 6-month contract
Hmm.
on a share.
Hmm.
Expected to pay no dividend during the period,
Hmm.
which is available at ₹75.
Hmm.
Given that the risk-free rate of interest to be 8% per annum,
Hmm.
compounded continuously.
Yes. Continuously means what formula we have to take? F is equal to S into E power RT. So E is a constant. E is because E is 2.718. This is a constant. E number E, that
It is a base of the natural logarithms.
yes, very good. Now you have to substitute everything in this. F is equal to 75 multiplied by 2.7. 2.718. In this, you should put above this 2.718 to the power of R is 0.08 into 0.5. So if you calculate this using a scientific calculator or this power, that will become 75 multiplied by how much?
1.04081.
1 point?
04081.
Okay. Just take some more decimals. So how much it will come to?
It is equivalent to 78.06, sir.
78.06. So that is the theoretical futures price according to our cost of carry model. Okay, so we have some reference. This is our valuation model. So what is there in the market can be different from this. Okay, like what you have seen in shares, no? In shares valuation also, we do some valuation models, but market price may be different. And depending upon your expectations, you will buy or sell. You may think that it is overpriced or underpriced according to your valuation model and do the things. So what is your valuation model? How you come to that expectation, I don't know. But market price is a certainty. Market price you can see. So depending on comparing this market price and your valuation model, you will come into the decisions. Jay, any questions or clarifications in this?
It is little confusing, sir.
Okay. No, you just remember that there is some there is this formula is there. What is the formula?
Sir, if we share the question in the group, it would be easy to understand, sir.
Okay, let me see where it is. Are you able to see the screen? No.
Yes, sir, it is visible.
Okay. You note down what are all given here. I want a forward price. What is the time period? 6 months. T is equal to 6 months. So 6 by 12. That is 0.5. What is the presently it is available at 75? That is spot price. S is equal to 75. What is the interest rate? Interest rate is R is 8%. That is 0.08. And you just simply substitute everything in our formula. What is the formula? This is the formula. F is equal to S into e power RT. Don't worry about this e power and all these things. This is some constant 2.718. Just I am trying. This is because it is a mathematical calculation. You substitute everything. Akhil,
Sir,
you see this question. You are able to understand what are all variables in these questions.
yes, sir.
Just substitute this in our equation.
Okay, sir. But I am not well in mathematics, sir.
Okay. No, not much mathematics. Just a simple substitution.
Okay, sir.
Sir,
Yeah.
if no problem, can I, sir?
Nana?
Can I try to explain that problem, sir?
Yes, please.
Okay, sir. Firstly, we need to, in this, we need to find out the forward price. The formula for this forward price is spot price into e power RT. Spot price is nothing but current price of the share. Here in the equation, they had given current price of the share is 75 rupees. So now we got the spot price is 75. And coming to the e power RT, in that E is base of the natural algorithm. It will be for everything will be it is a constant number, that is 2.71828. E is equals to, and coming to the RT, R equals to risk free rate. R in the sense risk-free rate. In the question, they have given 8% per annum risk for rate is. So 8% means we'll be getting it as 0.08. And coming to the T is nothing but time period of the forward contract. Here they have given the time period is 6 months. 6 months means we will be having totally 12 months. So we need to divide that 6 by 12, then we'll be getting it as 0.5 time. So now spot price is equals to 75, R is equals to 0.08, and T is equals to 0.5 years. So now we need to substitute in this formula. Forward price is equals to spot price into e power RT. We know that spot price is 75. 75 into e power. E means 2.71828. Power RT. R in the sense risk free rate. It is 0.08 into T, 0.5. And after this calculation, we will be getting it as 78.06.
Good, good.
Is it fine?
Yes, right. So all of you note down these steps. Are you seeing the screen, Jaya Jain?
Yes, sir.
Yeah.
Understood.
Yeah, just note down. And Harika,
Yes, sir.
yours is statistical background, no?
No, sir. BCom account.
Okay, fine. No, nothing much. It is only a small.
Yes, sir. Small cut.
Yeah. Okay, where I think I'm happy you have made some progress compared to yesterday. So once you get into this jargon, you'll be, we can move faster because it is like a doctor's language or something like that, where you should be comfortable with the jargon. All this, long, short, square of forwards, futures, all these things. So now,
Yes, sir.
any clarifications or questions, comment sessions, feedback? Otherwise, I will request Jay to summarize total what we have studied.
Sure, sir. So I didn't join the class right from the beginning, but still I joined from terminologies where you started explaining basis,
Sure.
cost of carry, margin account, initial margin, market, marking to market settlement, open interest and volumes traded. And then we understood all these terms in detail. Next, we saw price band. Under that, the position in derivatives market, long positions, short position, open position, naked and calendar spread position, opening a position, closing a position. Naked and calendar spread position, we understood with example, TCS example. So that was very helpful, sir. And then next we saw payoff for buyer of futures, long future. When price increases, we get profits. And when price decreases, we get losses. And if it is stable, then it is zero. And next we see a payoff for short position. In this, when price decreases, we get profits. And when price increases, we get losses. And if it is stable, it is zero. And then next topic is the cost of carry model. In this, mainly it is to identify the fair future prices. So for that, formula is F is equal to S plus C. And then we understood this formula by substituting with an example. Yes, sir, that was it. And the formula is F is equal to S into e power RT. Yes, sir.
Very good, Nana. That is, if any person listens to your 5-minute summary, that is enough. You have told better than me.
Thank you very much, sir.
So, very nice. What I request you is you go and do more homework. You increase your depth in these subjects. I'm very surprised that you are able to understand. All of you are be able to feel this. And I'm the first person to be happy when you grow more knowledge and become good finance experts. And no, you just go to this NSC website also, do more sort of related, because now sources are huge available. What is time in India?
8:26.
Oh, we have covered sufficiently. So I once again thank you all for in this weekend also you are able to attend, because I will be traveling in next week, 3-4 days. It will be difficult for me to take class. So what I will suggest is, if possible, tomorrow also you assemble at 6:30. Then we'll try to cover some more ground in this unit and module 2. I will share this PPT and everything to you, and then we'll continue this. Thank you very much, all of you. Jaya, Jay,
Thank
Akhil,
you, sir.
Harika, and
Thank you, sir. And have a nice day.
Thank you. Thank you so much. Bye.